Here is a beginner-level corporate finance manager quiz that covers tax planning and optimization, fundraising and investor relations, and performance metrics and KPIs. Let's go. Question 1. What is the primary goal of tax planning in corporate finance? A. To avoid paying taxes altogether. B. To minimize tax liabilities while remaining compliant with tax laws. C. To increase corporate expenses. And D. To delay tax payments indefinitely. Answer: to minimize tax liabilities while remaining compliant with tax laws. Question 2. Which tax strategy allows a company to reduce its taxable income by reinvesting profits? A. Tax avoidance. B. Capital gains, taxation. C. Tax deferral. And D. Profit diversion. Answer: tax deferral. Question 3. What is the purpose of corporate tax deductions? A. To increase a company's tax liability. B. To lower taxable income by subtracting business expenses. C. To increase financial risk. And D. To avoid financial reporting. Answer: to lower taxable income by subtracting business expenses. Question 4. Which of the following is not considered a deductible business expense? A. Employee salaries. B. Business rent and utilities. C. Office equipment purchases. And D. Personal vacation expenses. Answer: personal vacation expenses. Question 5. Tax credits differ from tax deductions because they A. Directly reduce the amount of tax owed. B. Increase a company's expenses. C. Are only applicable to large corporations. And D. Only apply to employee benefits. Answer: directly reduce the amount of tax owed. Question 6. A company engaged in international business can minimize taxes through A. Increasing employee bonuses. B. Delayed payroll payments. C. Transfer pricing. And D. Ignoring financial reports. Answer: transfer pricing. Question 7. The tax structure that applies to a corporation's profits before dividends are distributed is called A. Sales tax. B. Corporate income tax. C. Value added tax, VAT. And D. Personal income tax. Answer: corporate income tax. Question 8. What is the purpose of corporate fundraising? A. To lower product prices. B. To increase executive salaries. C. To reduce market share. And D. To raise capital for business operations and expansion. Answer: to raise capital for business operations and expansion. Question 9. Which of the following is a common method of corporate fundraising? A. Issuing stocks and bonds. B. Increasing employee bonuses. C. Selling office equipment. And D. Reducing marketing budgets. Answer: issuing stocks and bonds. Question 10. Equity financing involves A. Taking on debt that must be repaid. B. Selling ownership shares in exchange for capital. C. Reducing business expenses. And D. Avoiding financial risk. selling ownership shares in exchange for capital. Congratulations on completing 10 questions. Let's move ahead. Question 11. A company that wants to raise money without giving up ownership may choose A. Dividend payments, B. Equity financing, C. Crowdfunding, and D. Debt financing. Answer: debt financing. Question 12. Angel investors are typically A. Banks that issue long-term loans, B. Early-stage investors who provide capital in exchange for equity, C. Government institutions that provide grants, and D. Employees who contribute to business financing. Answer: early-stage investors who provide capital in exchange for equity. Question 13. Investor relations is important because it helps a company A. Maintain transparent communication with shareholders, B. Avoid financial reporting, C. Reduce operational costs, and D. Ignore market trends. Answer: maintain transparent communication with shareholders. Question 14. What is a key document used to inform potential investors about a company's financial health? A. Employee handbook, B. Annual report, C. Press release, and D. Customer feedback form. Answer: annual report. Question 15. Key performance indicators, KPIs, are used to A. Set arbitrary business goals, B. Track customer complaints, C. Measure a company's financial and operational performance, and D. Avoid accountability in financial reporting. Answer: measure a company's financial and operational performance. Question 16. The return on investment ROI metric measures A. The amount of taxes paid, B. The total revenue of a company, C. The number of employees hired, and D. The profitability of an investment. Answer: the profitability of an investment. Question 17. A high debt-to-equity ratio indicates A. A company is relying more on debt than equity financing, B. A company has no outstanding loans, C. A company has high liquidity, and D. A company is generating strong profits. Answer: a company is relying more on debt than equity financing. Question 18. Which performance metric measures a company's ability to generate profits relative to its revenue? A. Accounts payable turnover, B. Net profit margin, C. Inventory turnover ratio, and D. Debt ratio. Answer: net profit margin. Question 19. EBITDA, earnings before interest, taxes, depreciation, and amortization, is commonly used to A. Measure employee engagement, B. Determine total liabilities, C. Assess a company's operational profitability, and D. Track marketing expenses. Answer: assess a company's operational profitability. Question 20. A company with a high asset turnover ratio indicates that A. It is efficiently using its assets to generate revenue, B. It has high levels of debt, C. It is facing liquidity issues, and D. It is struggling to make profits. Answer: it is efficiently using its assets to generate revenue. How many did you get right? Comment below and subscribe for more.